Welcome everyone to today's RaaS Research Group Stocktake webinar, where we once again dive deep into the analysis of another promising ASX-listed stock. RaaS have gone through the ASX and delved deep to find another cracking company for you to look at and learn more about today. Today we're focusing our attention on Verbrec, ASX code VBC, a leading engineering, asset management, infrastructure and training service provider operating across the entire asset life cycle. They operate across multiple regions, including Australia, New Zealand, PNG, and the Pacific Islands, executing projects for organisations of all sizes. RaaS Research Group's detailed analysis, presented by Senior Analyst Graeme Carson, will cover all the main themes, financial models, and potential pitfalls any scrupulous investor should consider before making an investment decision. So pay attention to Graeme's presentation. He will give you rare insights into his view on the company and what you should be looking for. Graeme's presentation will be followed by Chief Executive Officer Mark Reid, who will provide a detailed presentation on the company, plus participate in live Q&A. So you will have the opportunity to ask questions directly to Graeme and Mark at the end of those presentations. This is your opportunity to learn. So feel free to submit your questions using the Q&A function on your screen throughout the webinar. I'll be collating these questions and putting them directly to our presenters during the Q&A session. Thank you for joining us, and without further ado, let's get started. Please join me in welcoming RaaS Research Group Senior Analyst Graeme Carson, who recently released detailed research on Verbrec with the key insights to be shared with you now. Graeme, over to you.
Thank you, David, and thanks to all the attendees for joining. So Verbrec, we've just recently initiated on Verbrec, so there's a very fresh and pretty comprehensive research piece available, released yesterday, and it's one that we think is really flying under the radar at the moment. So if we can go through the disclaimer here and onto the agenda, please. So what I'm going to do today is a brief company overview. I'll then spend a bit of time talking about the reinvigoration of the business, because it's actually a key part of the story, and it's one of the main reasons as to why we have a lot of confidence in our forecasts going forward and the ability of the company to execute. We'll then talk about the actual financial position, talk about our forecasts and how we value the business, and then we'll check that valuation against the listed peer group before we talk about some key sensitivities and catalysts that we hope to unearth in the coming months. So if we can move over to the company overview, as David pointed out, if you cast your eye to the top right box there, VBC is the code. It's trading around 13.5, 14 cents with a market cap of circa 40 million. It's a diversified engineering services business. Again, as David touched on, it says engineering, asset management, infrastructure services, and has a training business. Revenue is very much dominated by the engineering side of the business, which represents 93% of group revenue, or did so in FY24. We don't see that changing materially over the forecast period. The industries that the company focuses on in services are energy, mining, infrastructure, and defence. Again, there is one key standout there, which is the energy sector, which represents about 55% of group earnings. Again, we don't see that changing materially. We think there's growth in all businesses, but energy will probably continue to be the largest contributor. One of the main reasons for that is the macro environment. Within the company's revenue, they speak about areas of sustainable focus. That's about 33% of group revenue in FY24. We see that expanding over the forecast period. Difficult to analyse this with accuracy in terms of relative contribution, but we do think over time it will expand, and we have it representing around 39% of revenue by FY27. So the areas that within the sustainable focus part of the energy sector really relate, from Verbrec's perspective, to electrification and energy storage, and the gas market transition story, which is playing out already in response to the government's target of a net zero economy by 2050. So even though engineering space is obviously very competitive in Australia, we do think that there's areas of expertise that Verbrec can offer that are directly beneficial to these asset owners that are facing some pretty significant changes in the business over the next 10 to 15 years. It's also leveraged to sustainable mining. Around 50% of the mining revenue is in the sustainable area. and in water security storage. So that's about 50% of the infrastructure business as well. From an investment perspective, we see that this company is very well positioned at the moment with value relative to peer group and with income. It's completely funded for our growth forecast, so we don't see them coming to market anytime soon unless they're making some sort of big acquisition, which doesn't seem to be on the short-term agenda. By FY25, it'll be net cash positive by year end and very cash generative. We expect the company to deliver compound revenue growth in the low double digits and earnings growth higher than that with a bit of margin expansion. It's at a material relative discount to its peer group, which we'll talk about in more detail. And the company's also spoken of its target of reinstating dividends, and we assume that happens in the current year. And the yield at the moment, the 40% payout ratio will be about 5%. And we value it on a DCF basis, and the valuation that we find is 40 cents per share. So if we go to the next slide, which is the reinvigoration of the business, I've said that this is an important part of the story because over the last 18 months under Mark Reed, the CEO who will speak today, his guidance, there's been a significant turnaround in the Verbrec business. So the new management team has driven this, and they've done a lot of different things to make sure that they're driving efficiency and discipline through the business. Again, they've also made some big strategic decisions. They've divested some assets, most notably a part of the training business that was sold in December 23, and that results in an EBITDA, I think, improvement of 2.6 million a year or thereabouts. And the remainder of the training business is very focused. They are growing that side of the business, and it's already profitable. And they also recapitalised the business in December last year to the tune, I think they did a capital raise of 4 million, and that reduced debt, provided working capital and some growth initiative capital. And also, if you look at the business now being cash generative, we think it'll be net cash to the tune of about 2 million by June next year. Legacy projects have always been a problem for Verbrec and its predecessor Logicams. There's something that is rife in the industry. There's a lot of fixed price and mixed price or lump sum contracts in the past, and they have often detracted from, I guess, sustained profitability of the business. Now, the last of those projects was finalised by December last year. And if you look at FY24, the whole order book, in fact, delivered above bid margin performance at aggregate across the whole book. So that's really, really important for confidence for us, and it shows a discipline that management has shown. We also think that project delivery generally is improving, and the risk profile of the overall book is certainly better than it used to be. If you look at it now, the reimbursable O&M and training contracts, they're much less risky, and they represent 72 or 73% of the book. So that has changed markedly, and it's a pretty good position for an engineering services business to be in control of some of the variance that can come through project delivery. If you cast your eye across to the chart there on the right, I think this is a pretty good visual representation of what's happened. So there's two historical years there, 23 and 24. In 23, the revenue was 109 million, but the company lost about, I think, 2.9 million at the EBITDA line. Now, in FY24, they were much more disciplined, much more choosy about what type of projects they delivered them in a way that was very efficient and profitable. And even though revenue dropped to 93 million, they delivered 8.8 million of positive EBITDA. So, a reasonable drop in revenue, but a material turnaround in earnings. And that's what's given us the confidence about the efficiencies and disciplines. So off that base, we think the growth is back on the agenda. The management's got a new clarified strategy that they're executing well. And they've got some sort of key client relationships that sit at the core of the business in specific areas that we think are growing parts of their target markets. So if I flip to the next slide and talk about the numbers and our forecasts. Organic growth, we've said acquisitive growth there. They have the capability to do it because of the balance sheet, but all our numbers are purely organic. So we see a CAGR in revenue of about 12.2% from 24 to 27. Again, all organic. And the EBITDA growth that we see is at about 24% CAGR due to operating leverage that's going to come through the business, and a margin expansion story that we don't think that we've been particularly aggressive on. It's been a gradual expansion out to 27 for us. So there may even be upside to that forecast. It results in EPS growth CAGR of 22%, strongly cash generative, with a forecast conversion rate to EBITDA of 88%, which again is a material improvement. As I've said previously, net debt is 2 million at the moment, but we think it's improving to 2 million net cash over the next 6 months. It's a capital light business, so it's fully funded for all of our forecasts, with, we think, growth optionality. I will now touch on our valuation. We use a DCF valuation for the formal valuation, but we also look at some other key metrics that we think are pretty attractive. So you can see our DCF value of 40 cents there. We haven't been aggressive. The weighted average cost of capital at 13% reasonable. We've got a 1.5% beta, even though the observed beta is 0.66. So we've been much more conservative there, and a terminal growth rate of 2.5%, which is around about or even below probably long-term inflation. So we think that's reasonably conservative. Also, with the share price at 13.5 cents, your EV to EBITDA ratio in current year, FY25, is at 3.5 times, and the PE ratio is 8.6 times, and then the yield is 5.1%. So if we compare that in the next slide to the peer group, you can see here the range of 10 companies or so there. Now, the market caps generally are variable. There's some a lot bigger than Verbrec. You can see 800 mil average, and Verbrec's only 40. So you would think sometimes that would demand a higher multiple. But when we look at the growth forecasts in Verbrec versus some of the others, we think it's positioned very, very well to grow faster and potentially for a re-rate as well. So the sector's on an EV to revenue multiple of 0.63. Verbrec's on an 80% discount to that. On an EV to EBITDA basis, the sector's trading at 6.6 times. Again, Verbrec's trading at 90% discount to that. And even on a PE level, it's trading at over 50% discount. So there is real relative value here. And we think that the market isn't yet really attributing much value to the turnaround that Verbrec's actually delivered. And when that does become evident, we would expect it to trade up more towards those multiples. Again, these are only 1 year forward, so you're not capturing forward earnings beyond that. We think that's captured in the DCF valuation over the medium term. So when we look at our key sensitivities and potential catalysts in the next slide, we talk about an upside case and a downside case here. Now, these are upside and downside relative to our current forecasts and current valuation. So we've got revenue growth of about 12% or thereabouts over the forecast period. We think there is likely to be periods where the company delivers ahead of that. We're not forecasting it, but we think there's upside surprise, and we wouldn't be surprised if we see mid-teens growth in any of the given periods. Also, the margin expansion story at the EBITDA line, I've mentioned that we've got it progressing and expanding gradually out to 27. They may be able to deliver that more quickly, but for conservatism, we've just made it a bit of a steady situation. And, the cash generation and the balance sheet flexibility that this company has could be used for further growth strategies. We've basically just let the cash build in the balance sheet. In reality, it's probably going to be used for growth strategies, but until they become clear, we obviously haven't included them. Downside case is always risks, and in this sector, the biggest risk generally is probably project underperformance and how that impacts profitability. Now, we've gone through the reasons why we have confidence that this has improved markedly for the business, but I guess you never say never. You never know what comes out of the field. And obviously, you're working in an area that's a huge industry in Australia, and the macro environment can have a big impact on the outcomes. So we have to be mindful of that. The biggest cost to this business is by far and away its labour force, and there have been various times through every cycle where that presents challenges, something the company's managing well, but it's always going to be there. And of course, the other risk is that they don't deliver the margin expansion story that we believe that they can. What are we looking for in catalysts? Well, we think this is a re-rate story. In other words, once they prove that they've got the sustainable earnings generation under control, and it'll increase the credibility of the company a lot, we think it will re-rate back towards the industry average, if not above, because of the growth superiority. And part of that would be signs that the margin expansion story is playing out. We've also said M&A activity. That stands for most companies, whether they buy someone else to accelerate growth or become a target themselves, will be a catalyst either way. So that is a bit of a rundown for me. As I said, there's a pretty extensive report out that's got a lot of detail around the things I've been discussing, which will be made available to everyone. So at that point, David, I'll hand back to you.
Thanks, Graeme. A detailed analysis for sure, and a great synopsis, if you like, of the research report that has been released in only the last, I think, 24, 48 hours. So I urge everyone to download the research from the RaaS Research Group website and do your own research and read the thorough piece that has been prepared by Graeme. On great synopsis and a great entree into now the formal presentation, which will be presented by Verbrec's Chief Executive Officer, Mark Reid. Mark, over to you. We look forward to hearing the story and complementing Graeme's entree. Thanks, Mark. Over to you.
Well, thank you, David, and thank you, Graeme. I really appreciate your introduction there. And can I say welcome to everyone on the call today? As David's indicated, my name is Mark Reid. I'm the CEO of Verbrec, and I'm very excited to be here today to tell the story that we think is a very exciting growth story, that is Verbrec. We've certainly had some tougher times in the past. We've now got this great base for growth, and we're looking forward to continuing our growth and our way forward from here. Before I do start the presentation proper, I would like to acknowledge the traditional custodians of the land on which we meet today and pay my respects to the elders past and present. And also thank RaaS for the great opportunity to present today and to talk about the exciting Verbrec journey. The presentation has some statements and forecasts, but I just for completeness, Verbrec is not providing any earnings or revenue guidance for the full year at this point in time. The first section of this presentation, really, I'd like to briefly talk about Verbrec, talk about our clients that we serve, and highlight the points of differentiation from our peers. If we start off, Verbrec's a leading professional services company, as Graeme's indicated. We operate out of Australia and the Pacific, and we have three core markets we're very proud of: the energy market, the mining market, and the infrastructure market. And our value proposition is very much building of strong relationships. We build strong, trusting relationships with our clients, and we work with those clients to enable a sustainable future for those clients, and by extension, their customers as well. And as Graeme's already highlighted, our focus on electrification of everything in the gas market transition really puts us in the sweet spot of the market at the moment as the market transitions to a net zero. Sorry, next slide. My apologies. What is the strength? Why are we different, and what is our value proposition? Our strength, Verbrec's strength, is all about our ability to collaborate with our clients early, and we add value through the entire life cycle of an asset. We think of ourselves as a one-stop shop, if you like. You can see on this slide here, we engage very early on with these very strong client relationships we have in the early engagement phase, where we'll engage with the clients in terms of conducting studies, selecting appropriate technologies for investment, and assisting in investment decisions. And then we can move right on to the engineering. We can support our clients through the delivery of engineering as they make their capital investments and look to maximise asset returns. And beyond that, we also provide some support around construction management, or actually in some cases, if it makes sense and if our engineering strengths adds value, we will look at taking some hard money construction risk on behalf of the client as well, an EPC delivery approach. And then moving smoothly into sort of the asset management piece. We have a very strong asset management business that provides operational readiness services when a project is started up, right the way through to spending time on asset integrity, looking at the assets of the client, working out how to make 40 the next 30, and 50 the next 30, and 40 in terms of extending asset lives. And that asset management piece of the business for us has been incredibly successful and profitable over the last few years. And then smoothly into operations and maintenance. We operate and we maintain assets as well, which means we have this very well-connected relationship with our client right the way through from the start of a project all the way through the entire life cycle of the project, right the way through to the end of the project where they might decommission or repurpose. We can be there as well. And overlaying all that, we have a training business, the competency training business that assists in the high-end electrical training of that client and of that business and that project. If we look at operations and maintenance for a minute, we're very proud of the fact that at the moment that we're operating approximately 2,000 kilometres of pipeline and associated assets through Australia. So it really means that we are with the client, that one-stop shop approach, as I talked about, that very closely wedded relationship and true understanding of the client's drivers. And the other benefit that gives to us is it also allows us to learn from our operations, our asset management, our operations businesses when it comes to the design of the next project. Next slide, please. So this slide really tries to show that sort of circular business. We really pride ourselves on being that recognised partner for the sustainable future and enabling our clients' energy transition goals. And it is through that long-lasting relationships that we get a substantial portion of our revenues generated through these very strong relationships we have and through multi-year operational contracts and panel agreements. And if we can go to the next slide, please. You'll see here we're really based around very strong relationships with 20 key clients that give us around about 70% of our revenue, and we have 43 multi-year panel arrangements and 14 multi-year operational contracts, which really guarantee and secure our performance going forward, and as I was saying before, gives us a reliable revenue stream and keeps us very connected to these very high-profile blue chip clients that you can see on the slide here. If we go to the next slide. So I now want to spend a little bit of time on our financial highlights. We think of financial year 2024 as a recovery period. As Graeme's already highlighted, we took the time to close out a number of underperforming projects and close some divisions that were holding us back. Really has allowed us to set new foundations for profitability and growth. And the outcome has been particularly pleasing. And probably the next slides, I'll walk you through some of the key elements of our financial results for financial year 2024. So if we can just go back one slide, please, David. Thanks. Yeah, so on an absolute basis, we've achieved the best EBITDA and profit margin performance since Verbrec was formed. Verbrec was formed by the merger of OSD and Logicams in 2019. Indeed, we've achieved the best EBITDA and profits for our business since 2015, so almost a decade. And as highlighted by Graeme, there's an $11.5 million turnaround of comprehensive profit from financial year 2023 to financial year 2024. Also highlighted, there's a slight reduction in revenue. We're actually quite proud of that, if I can say we're proud of a revenue reduction, because we focused on a better focused approach to clients and projects that we've taken on that earned margin for us and that had favourable economic prospects. This approach means we've produced a far better return on our revenues than in previous years and sets ourselves up very strongly for the growth phase coming into 2024, 25 and beyond. Next slide, please. This slide shows some points of notes from our profit and loss statements and our balance sheet and also a cash flow statement. Importantly, we've reduced our liabilities over the past financial year from 41 million to 28 million, while owners' equity is increased from 13 million to 19 million. We've also produced an operating cash inflow of $2 million, contrasting with a considerable net outflow in 2023. And pleasingly, our cash reserves at the end of the period remain stable and on a positive going forward, as highlighted by Graeme. If we can go to the next slide. When we think of last year as a year of recovery, we are looking ahead to this year as one of sustainable and profitable growth. So what we've tried to do here is to present our view of 2025, the outlook for 2025. You can see here we've identified current work in hand, also highlighted sort of weighted opportunities that are in the pipeline, and this pipeline is solely a 2025 pipeline, work that will be won and the portion of that work that will be undertaken in the year 2025. So we've tried to give your audience a view of sort of where the revenue is coming from in this 2025 year. The other point I'd say before I go into a little more detail on this is this pipeline does not include the competency training pipeline. It includes the engineering piece of our business. So I tried to give a view of where that revenue would come from. One point I would like to highlight here too, and it pertains particularly to the $121 million piece of the pipe. We've spent a lot of time focusing on improving our win rates, getting better client relationships, understanding clients better, being able to better perform and to give better solutions to our clients, and that has shown up in an increased win rate. Our win rate's now at 36% for financial year 2024, above the sort of 31% odd we had the year before. And our expectation is that we can equal or maybe even better, hopefully better, that win rate in financial year 2025. Go to the next slide. Next couple of slides, I want to spend a little bit of time talking about our refreshed strategy that we developed in 2024 and how we are going to achieve that growth in 2025 and beyond. We go to the next slide, please. We recognise that as the market evolves, so must our strategy, and our strategy is all about a combination of diligent, some might even say ruthless focus on our relationship clients, on our people, and on our capacity and capability, making sure we have the capability to deliver on the strategy, and through client delivery as well. And Graeme's mentioned a couple of times about our improved client delivery of last year. We've seen some real improvements there. Need to keep focusing on client delivery, critically important to the future of our business to achieve the growth in the market. So we've taken a ground-up approach to developing that strategy that maximises Verbrec's potential and closely aligns with our clients' journeys to achieving a net zero future. Next slide, please. So 2025, we expect to see a growth in revenue and profits. And where does that growth come from? It's a combination of elements. The first one is organic growth, around our clients and around doing more with those clients. Geographic expansion. We do great work for our clients, for example, in some jurisdictions, maybe not in others, yet those clients want us to do work for them in those jurisdictions as well. So there's a geographic expansion play as well, which will maximise our revenues. And that plays into the panel agreements and the key client relationship approach we've taken. And there's a special mention to our operations and maintenance contracts as well, these longer term contracts, which we intend to keep building on. I can talk a bit about later. So the energy transition's the other major pillar of our growth strategy. Being there front and centre for our clients in this energy transition, which is not a one-year transition, it's a multi-year transition. Next slide, please. So we talk about 4 sustainable areas of focus at Verbrec. These are areas where we see ourselves best fitting into the evolving landscape and our client sustainability journey. And it's really our sweet spot where, when we look at this sustainable focus areas, we're in a great place. We have the right capabilities with the right clients in the right geographies to be able to respond to our clients' changing goals. And if we look at the 4 areas, the first of the focus areas is electrification and energy storage. It is a core business for Verbrec and has been for a long while. So we're already working in this space, providing innovative solutions on things like system modelling, battery technologies, be it the more traditional sort of batteries like the Elon Musk style batteries, as I call them, or some of the more advanced deep storage batteries like the flow batteries. Investigating geothermal energy, hydro energy solutions. We're involved in a number of locations now, and actively pursuing other opportunities to more meaningfully contribute to solar and wind sector as well. A particular focus for Verbrec is the second pillar here. It's the gas market transition, perhaps a transition that wasn't talked about as much about a year ago, but certainly has come into full focus in the last 6 months or so as the shortage of gas and some of the gas issues become more front of mind. It really fully aligns with Verbrec's current core capabilities and client base. It really is a critical area where Verbrec can maximise its offerings as gas transitions from a base load fuel to a peaking or firming fuel. We're already established in this area. There's a lot of pieces to that. How do we manage storage better? How do we make sure gas is in the right place? How do we make sure there is enough gas? Looking at services around peaking gas plants, along with now going into the biogases, the carbon capture and storage, and some of the other emerging technologies as well, like the methanes, for example, and possibly even hydrogen. Along with providing engineering asset management support to key mining clients, this is the third pillar throughout Australia. Verbrec's digital twin product Stacks On enables our mining clients to deliver on-spec performance and better control of their product in challenging conditions, increasing throughput and reducing downtime, and contributing more profitable, sustainable stockyard management. And I have a slide to talk about that in a bit more detail later. Verbrec is also an important contributor to water security through Australia and New Zealand. We provide expertise to water authorities and other partners in this critical industry by designing, constructing and maintaining water assets, including traditional water infrastructure, desalination plants and water treatment facilities. And as mining continues to grow and develop throughout Australia, the challenges to get water to those mines becomes more and more critical, and the management of that water once it's at the mine. Next slide, please. To put a bit of context to sort of the drivers towards drivers of the energy transition. This graph is part of AEMO's 2024 Integrated System Plan. I've picked a few graphs out of that, and it really, in a snapshot, demonstrates the magnitude of the additional capacity, the additional investment, the additional energy and excitement in the evolving energy landscape in Australia. I mean, just to pick a couple of stats here. Energy storage will need to increase 15-fold by 2050. Gas peaking plant capacity will need to significantly increase, while many of the traditional gas market assets will need to be decommissioned or retrofitted and repurposed. And electrical consumption is predicted to nearly double by 2050. AEMO predicts the optimum development path will require a net present value of $122 billion in annualised capital costs, whereas other authorities like the Australian Industry Energy Transitions Initiative has placed the investment closer to $600 billion and more, and a similar story in New Zealand as well, where we also have a strong presence. I suppose the truth here is that no one really knows exactly how the transition will play out, or what the overall investment will be. But what I do know is Verbrec is working with our clients and their advisors, developing the right strategies to deal with that whole energy transition. Next slide, please. And we're already on this transition journey. A number of slides here, a number of pie charts here. The charts show our three core markets. More than 33% of our project portfolio comes from our sustainable focus areas. And as Graeme has highlighted, and we concur, we expect this to grow over time as industry continues to transition to a more sustainable future. Next slide, please. Next part of the presentation, really wanted to go through some of the really exciting projects that we've been delivering and are delivering at the moment. These are current clients. And if we start off with the next slide, the first one is the Broadlands Biogas upgrade facility. On the 6th of November, so very current, 2024, First Renewables announced that the First Renewables Biogas to Pipeline upgrade facility at EcoGas's organic processing facility in Verbrec in New Zealand is now in production. I highlight that James Irvine, the General Manager of Claris Future Fuels, hailed as a historic milestone for New Zealand's gas pipeline infrastructure. Just to go back a step here, this is taking municipal waste and producing from that a biogas that has been cleaned up and is suitable and is being put into the commercial and residential gas system. So it is a direct replacement for natural gas in New Zealand. We provided the front end and detailed design engineering services for this landmark project, and really will have a dramatic effect on the reduction on the reliance of fossil fuels in New Zealand to homes and business. It's through this sort of collaborative relationship client-based approach that Verbrec's been able to provide engineering services to Claris for over 15 years. One of these very strong client relationships we've had for a long time, and Verbrec's tremendously proud of the part that we've played in enabling the renewable gas flow at the First Renewables Biogas facility. And there's an expectation we will see a lot more of these style of projects going forward in not only New Zealand, but certainly Australia as well. Next slide, please. Near the end of the financial year, last financial year, we secured our first multi-year pipeline operation and maintenance contract in Western Australia. Pipeline operations is a core service offering for our operation and maintenance team, and provides a predictable multi-year baseline of revenue for the group. You know, we have 3- and 5-year contracts in this space. Western Australia has relatively few competitors in this space, so us breaking into this market is a real achievement for us, and gives us the opportunity to introduce our competitive offering into this region and secure a greater market share in what's a very hot market in Western Australia. Through this operation and maintenance contract, we'll provide Pacific Mining with operational assurance and ensure pipeline integrity through continuous performance monitoring and right-of-way surveillance, and potentially engineering services on top of that O&M contract. As I said before, we operate and maintain over 2,000 kilometres of gas pipeline across Australia, which makes us the leading independent operator and maintainer of gas pipelines in Australia. Next slide, please. We certainly specialise in innovative engineering and project delivery solutions to clients through a technical specialties, and we have a number of those, including automation and control, power, process plant, and pipelines. We've recently been awarded the front-end engineering, the FEED as it's known, for one of Australia's largest pipeline development projects, the order of 300-kilometre pipeline. The pipeline's poised to be a crucial asset in enhancing energy security for New South Wales. By improving the reliability of gas supply, the pipeline will contribute to stabilising and reducing the gas electricity prices for households, manufacturing, and business across the region. It may well also be a good insurance policy to make sure the gas is actually available full stop under a number of scenarios. And while I am on the topic of gas pipelines in the Eastern Seaboard and gas into the Eastern Seaboard of Australia, we've been involved in the engineering of the first gas import terminal into Australia in Port Kembla, where we've done the engineering of the onshore facilities there. And there's an expectation there will be other import terminals required in Australia in the coming future. Next slide, please. I haven't spoken a lot about our training business, which is a bit remiss of me, because we're unbelievably proud of our training business. Our competency training business, as it's called, specialises in delivering courses providing qualifications for clients in high-end areas like hazardous operations, high voltage switching, electrical and renewable energy, sort of instrumentation, automation. We're not only seeing an increased demand in Australia for these services, but we're also seeing a growing demand from international customers looking for better training and competency assessment to meet stringent electrical standards required by the Australian market. It's CT, competency training's impressive reputation in the market, which has secured greater market share for us, and it continues to grow rapidly. As I noted earlier, we've continued to grow our footprint, and we've grown from six locations to 11 locations in financial year 2024, as the demand for quality electrical trades continues to grow. Next slide, please. Stacks On, which I alluded to previously, is a digital twin for stockyard. So it models stockyard and stockyard performance, enabling on-spec product to be managed and tracked very effectively. What goes onto a stockpile, where, and when you reclaim it and put it onto another conveyor when it goes to a train, for example, or a ship. Greatly increases throughput and reduces downtime for the people that are using this very impressive product. The product itself the revenue is generated through a blend of software license fees, a sort of a SaaS, software as a service product, and ongoing support and consulting services. Growth in this business, and I should say, the Stacks On product is used on every single iron ore stockpile that BHP has in the Pilbara. And we're looking at how we can expand that product more broadly, be it for additional services of BHP who have gone into print and spoken very positively about how it had improved the performance of their plant and how it saved them considerable amounts of money. We're looking at how we can grow that. How do we grow that into other areas of Western Australia, the other iron ore mines in Western Australia, as well as how we can grow the product into other commodities. For example, the coal in the east, possibly even things like areas like copper as well. So expanding into these other commodity markets and stockyards is another area of focus for us. And we look forward to that achieving strong revenue growth for Stacks On. We go to the next slide, please. So that was really the end of the presentation proper. To finish with some concluding remarks, the board and management of Verbrec has worked unbelievably hard over the last financial year to set a new foundation for profitability and growth, putting the scaffolding in place to be able to launch, to grow into 2025 in terms of revenue and profit performance. We believe those outcomes are now self-evident, with the highest profits since 2015 and the highest profit margin since the merger of OSD and Logichem in 2019. We've repaired our balance sheet. We've optimised our operations to produce revenues that dramatically reduce cost of sales. And we've got a strategy that's in place and active, and we're now in a position to grow our revenues and profits 2025 and beyond. A substantial proportion of our revenues is reliable and recurring, fueled by these long-term contracts and very, very strong client relationships and trusted client relationships. Our growth-targeted business units, including our asset management business, our operations and maintenance business, and our competency training business, are performing strongly, and we anticipate that trend to continue. And returning to producing dividends for our shareholders does remain a core goal for us, and will be front of mind for our board and management team over the coming financial years. So in summary, I really am genuinely excited about a very bright future that I see for the company that is Verbrec, and the role we can play in enabling a sustainable future for our clients. So thank you very much for the opportunity to present today.
Thanks, Mark. Quite a stack of questions have come through, so we will jump straight into them. A great presentation, really set the scene for the questions coming through. There's a question here, and probably a question and a statement, and I think it's more a commendation for yourself and the management team on the work that's been done since the merger of the two businesses, and the work that needed to be done to turn the businesses around to get them to a point of profitability. Take us back a little bit. What were the steps that you took to achieve this turnaround, and how are you addressing the challenges of maintaining and growing profits in a competitive market?
Sure, thanks. Yeah, so I suppose the first thing we did was to actually step back and have a look at the business, and I joined about 1.5 years ago, and Richard Aiden joined at a very similar time, and we had a look at the business. And I think the first thing that struck us and the rest of the very competent management team that's here at Verbrec is that fundamentally the Verbrec business was a strong business. It was a good business, but it had been through some pretty tough times. So you know, we had a really good business to work from, if you like, and to build. Then we did a review of where the issues that we needed to address were, and look, there's quite a list of them, but we looked at the training business, and our training business had two parts. One part, the CT business I've spoken about, was very strong. The other part, not so, didn't really meet our business model where engineering adds value, and if we can add value through engineering, then that's a good part, and we can add value for our clients. That's where we should be. So we sold that business, and that's so-called SST business. We took a hard look at those so-called legacy projects, and we worked through making sure that they were complete, any liabilities were extinguished, we'd signed off on them all, and we could leave them in the waste bin of history, and continue to move on from there. And we set about doing that as well. We did a full operational review and cut the sword to some overheads that were not appropriate for a business of our size and our scale and our strategic direction. And we found about $2.3 million worth of annualized EBITDA savings there, and they're ongoing savings, which we were able to take out of the business. We had some parts of our business that really didn't make sense to be involved in. It's just straight construction. Now, if engineering adds value, that's fine, but straight construction didn't make a lot of sense, so we wound down some of those areas. We continued to strengthen our key account management program, continued to hold our managers accountable and responsible for the parts of business they ran. And focused on making sure we didn't get into projects that were bad projects. You know, it's always easier to deliver a good project rather than to try and fight your way through a bad project. And of course, as part of that was greater project management rigor and greater oversight and review. So not one simple answer to that. Obviously, strategy we recut as well, and we took a hard look at the stacks on business and got excited by that as well, and so put some energy and into that business as well. Again, no silver bullet, but just a series of steps to get us to a point where we are now.
And just touching on stacks on, there's a question here around market strategy or the go-to-market strategy. What's the plan? And do you have a view on the addressable market size, or is it a learning as you go?
We've done a lot of work on stacks on. One of the first things we did is we employed a new general manager for stacks on who comes out of that software as a service business. His most recent role was with K2 Fly. He'd sold his business into K2 Fly, so he's done a lot of work in conjunction with the team. But to answer your direct question, simplistically, every mine, every bulk material product like a coal and iron ore or whatever, where they have stockpiles and they put things onto a stockpile and take things off a stockpile, is an available market for us. And we have done market surveys and world reviews of that. But let's crawl before we walk. Our first market, BHP iron ore like the product. We're doing very well with BHP. How do we offer them more services? How do we then convince Rio Tinto, Fortescue Mining, and some of the other people of the benefits as well that we see with the product? And then how do we go over to the eastern coal and get some of those clients like the BHPs and the Rios and the Anglos and some of those people who also work in coal. How do we get them excited? So that's our step out strategy. Obviously, the market is very, very large, but let's do it in bite-sized pieces, and that's the journey we're on for the next year or two.
And Graeme, just a question for you while we're on Stacks On. Have you given any value at all to that part of the business, and how do you value that part of the business?
Yeah, look, in short, I haven't ascribed separate valuation for Stacks On. Again, I just took a conservative stance on it. I did consider it. And as we know, SaaS revenue is recurring and high margin revenue and generally gets ascribed a higher multiple by the market. So I see it as upside. As Mark's pointed out, at the moment it's very well entrenched in BHP. That revenue that's generated sits within the engineering division. I assume a little bit of growth in there, but nothing material at all. So let's see where management takes it. They're obviously very focused on it now with a growth story around it. So I just wanted to see, I guess, how it gets proved out over the next year or so. But it certainly could sit as a separate asset, being valued differently over time. So I think it's upside, if anything.
And Mark, just in relation to your annual report, there's a comment here that people can see from your annual report that a large portion of your revenues come from the energy and gas market space. How do you see this area changing over the next 5 years or so?
So we see we see a sort of a percentage of our business being about the same in a growing business, but in terms of how the market's changing, we're going to see a lot more of what we talked about in the integrated system plan. We're going to see a lot more bioenergy talked about. We're going to see a lot more, I think, a lot more talk about hydrogen. We're going to see a lot more talk about some of the so-called green fuels, the sort of e-methanes, for example, the combination of carbon dioxide with hydrogen to produce a methane product. You're going to see a lot more of that. Crazy as it sounds, we are going to see more import terminals in that gas space in Australia and New Zealand as well, as we grapple with sort of the issues with shortages of gas and concerns about guarantees of supply. So yeah, we see in that gas space a lot of activity. I think just while I'm on gas, gas being used in different ways, as I talked about before, as a peaking fuel, and so greater storage facilities, carbon capture and storage will be talked about more. Gas will start going in pipelines different ways. You'll see all of that whole thematic work out. And of course in the whole electrification of everything space, advancements in batteries, a lot more wind. I think you'll see some more advanced technologies coming into play there as well. It's a very exciting space to be part of, and I'm very excited that we have that sort of capability to play in that sort of what we call that sweet spot.
A question here around revenue concentration. Do you have, are there any key clients that sort of hold the bulk of your revenue, and what percentage of revenue is recurring on an annualized basis?
Sure. So in very rough terms, 20 our key 20 clients that we're very proud of as clients we have these long-term relationships with and through the whole life cycle give us about 70% of our work, just a bit shy of 70%. Of those, probably the Santoses and the BHPs and the Origins are our key ones, but they're all very great clients of ours and give us great revenue streams, and we're very proud of those relationships. Just while I'm on that, we talk to those clients regularly and seek to understand their drivers going forward, as I highlighted before. If we were to add 20% revenue to every one of those clients this year, then 20 times 70 is 14-15% growth. So you can see the importance we place in those clients and the importance and the trusting relationships we have with those clients. And so we're certainly very excited by how we can continue to grow those markets. If I think I've understood your question correctly there.
Yeah, none of that handled it beautifully. And there's a question here around, during your presentation, You talked about the work you do early with clients, and the study work you do early to sort of understand the potential projects that clients haven't come down the pipeline.
Yeah.
From an engineering business point of view, we see a lot of contracts blowing up because the work's not done early to really understand the complexities of the job, but also the structure of the contract. Is that early work, is that the bit that's paying the dividends?
It's certainly one part. There's a couple of other parts I can touch on as well. I think the first thing I'd say is when you're actually having those trusting relationships and you're actually having a seat at the table when people are looking at their options going forward, there's an engineering piece to that, but there's also just a pure understanding their business part as well. So it's really important to understand their true business drivers so you can respond to those. If you're responding in an appropriate way to those business drivers, you don't have these difficult moments later on, or hopefully you don't, because you fully understand what the true drivers are of the business. If it's a capital cost issue versus an operating cost issue, for example, is it a technology risk versus stay with an established technology? All those sorts of discussions, and how's funding coming, and what's the cost of operation and maintenance, a lot of those issues. So very important you understand that, and we work with the clients there. But to your point about sort of cost blowouts, a lot of the cost blowouts tend to be when you enter into contracts without having fully understood what is to be delivered. And one of the things we've done is we're doing a lot less of the sort of the pure lump sum construction style work, and we're now having more meaningful, more useful discussions, I would say, with our clients where we will do more of the engineering before we start talking about the construction piece. So you're better specifying what they want and why they want it before someone's then putting in a lump sum price to deliver it. And that's been a very important change for us, and I think has added a lot of value to the clients in terms of managing their risk as well.
And is that the piece? The comment here is really that's the piece of the life cycle journey of a project, as opposed to just coming into bits.
Well, that's certainly the construction piece of that. I guess when talking about the life cycle, also saying, well, yeah, we do the engineering, and then we can oversee construction, but then how do you actually get it operating? So there's what we call operational readiness piece to actually get it ready for operation, and then there's how do you set up the asset management systems to make sure you're properly managing the plant, and how do you have the right SAP systems or whatever, and doing the right maintenance in the right way, and then on beyond that, once you've got all those systems set up, then there's actually you physically got to operate it and maintain it. So the more the blue collar style work, and so what I meant by the whole life cycle is not only have you done the engineering in the first place, but you've stayed with the client right the way through the management of the asset, through the operations, in fact at times right the way through to the closure. So you are a true partner for the entire life of that project, be it 10, 20, 30, whatever years.
In a competitive market, does it take discipline to say no to jobs?
Yes, it does. But that is part of strategy, isn't it? I mean, knowing what you want to do is important, but it's equally as important as knowing what you don't want to do is the key to an important strategy. So sometimes you'll have discussions with clients who want to do things, and look, the client's the client, but you can certainly point out the benefits and the shortfalls of some of the things they want to do and try and help them through that. Yeah.
There's a good question here that's come through, and I'll sort of pose this as the last question for you, and it sort of flows on from the last question asked, is how important has it been to mitigate risk in the business as you turned the business around over the last few years?
I suppose the easy answer to that's been critically important. It's how you do that, and in what way and what systems you put in place to manage those risks that really become the key question, I think. If you take project delivery, for example, I think you don't want to go into projects that have sort of undue risk in the first place. Once you're into a project, you need to do proper risk analysis. Well, hopefully you've done it before you're into the project, proper risk analysis on the project, and make sure that you have you have the right reviews in process, you've established the review protocols, who's to look at what and when and how, so that you can actually deliver the project in the way you want it delivered. You know, you can never totally eliminate risk, but you certainly, it's critically important that any risk that's there is managed and priced.
Graeme, quick question for you, final question. You did bring up a slide that looked at the comp analysis between all the engineering services, industrial stocks, and you did highlight the significant gap between the valuation between Verbrec and its peers. What are you going to look for over the next 6, 12, 18, 24 months to see that gap decrease?
Look, I think there's two things. You're going to get the underlying earnings growth that's going to drive growth in the price, but on a relative basis, I think it's all about you know, delivering an increase in confidence of the market, then improving the credibility of the business. And I think that'll be a stepped process. And every time there's another good interim result and another good final year result, you know, investors are going to be you know, attracted to the business. So the growth is going to come in two forms in my mind: the actual underlying earnings growth, and then a potential re-rate on top of that.
On that note, we've extinguished all questions. So I would like to thank both Graeme and Mark for presenting today. Gents, thanks for your time.
Thank you, David. Thanks, Mark.
Thank you.
I'd also like to thank each of you for participating in the webinar and engaging in the Q&A. A stack of great questions, and I think really provided significant insights into the business and its plans for the future, built off the strong foundation of the work done over the last few years by Mark and the executive team. So thank you everyone for participating today. We hope you found this webinar informative and valuable, and we look forward to seeing you at our future events, where we will once again dive deep into the analysis of another promising ASX listed stock. Thanks everyone, and have a great day.